Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Revera Pharmaceuticals.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis.
Yeah, let's. We're looking at a clinical stage biotech that is showing some really fascinating inflection points.
It is. For the longest time, this was just a pre-revenue cash burn story. But that's starting to change.
That's the key, right? While the income statement is still, dominated by R&D, they actually reported revenue.
They did. $1.87 million in Q1 2025 from their commercial product, Vivi.
And that's a recombinant human hyaluronidase.
Correct. And that revenue figure, it's a 16.9% jump sequentially from the fourth quarter of 2024.
So not a huge number in the grand scheme of things, but the trend is moving in the right direction.
Exactly. And you can see the operational discipline that's coming with it.
How so?
Well, they've cut their quarterly net loss significantly.
Okay.
They reported a $4 million loss in Q3 2025, which is a huge improvement from the $8.4 million loss the year before.
So they've cut their burn in half.
Pretty much. And they've been consistently beating the consensus EPS estimates all through 2025, which signals that their cost controls are really taking hold.
And speaking of control, what about the balance sheet?
That's another bright spot. It's a clean slate, zero long-term debt.
Okay, but they did just complete a public equity offering, right? Two of them, actually.
They did, a $9 million one and then another $5 million offering. And that, it caused some turbulence in the market.
Of course. Dilution is never fun.
No, but that dilution bought them something critical. Time. It successfully extended their cash runway right through their key regulatory milestones.
So it reduces that near-term financing overhang.
Precisely. As of Q1 2025, they were holding $44.6 million in cash.
Which is pretty substantial, especially with that declining cash burn rate.
It is. And management is even targeting free cash flow break-even by the fourth quarter of 2026.
That's ambitious.
It is, but it's contingent on reaching about $12 million in annual revenue, which, seems achievable given the trajectory.
Okay, so the financials are stabilizing. Let's unpack the real value driver here, the lead asset, brilaroxazine.
Yeah, this molecule is the primary reason to be looking at the company. It's targeting multiple neuropsychiatric indications.
And the story here is all about de-risking, isn't it?
Absolutely. We've seen positive phase 3 data, which is great. But the crucial piece is the positive 1-year open-label extension data from the RECOVER program in schizophrenia.
Why is that 1-year data so important?
Because long-term safety and efficacy is everything in this space. It's exactly what the FDA and what prescribers want to see before they trust a new molecule.
And this data now gives them a clear path forward.
A very clear path. Management is targeting a key pre-NDA meeting with the FDA in Q4 of 2025.
So just around the corner.
Right. And if that meeting is successful, it sets them up for an NDA submission in schizophrenia targeted for the second quarter of 2026.
Now, this is where it gets really interesting for me. The competitive moat.
Yes. Brilaroxazine is being positioned as a next-generation serotonin dopamine modulator.
Meaning it's designed to avoid the major tolerability issues of the current drugs.
Exactly. Things like weight gain, metabolic problems, and those extrapyramidal symptoms, or EPS.
If they can deliver similar efficacy, but with a much better safety profile, that's a game changer.
It translates directly into better patient adherence, which is a huge problem with schizophrenia, and it opens up a massive opportunity for market share.
And let's not forget the optionality outside of CNS.
Right. Brilaroxazine also has an orphan drug designation from the FDA.
For idiopathic pulmonary fibrosis, or IPF.
Correct. Which grants a potential 7-year market exclusivity in the U.S. for that indication.
Plus, they recently secured a European patent for pulmonary fibrosis, too.
Which really strengthens their protection in those high-value respiratory markets.
This all points to the company being more of a platform play, not just a one-drug story.
It's absolutely a platform play. They're leveraging their IP, pharmacoengineering, dimeric targeting, and conjugated delivery.
Which is why we need to look past brilaroxazine to the other assets, like RVX-212 and RVX-208.
Let's start with RVX-212. This one targets moderate to severe plaque psoriasis.
And it recently received FDA Fast Track designation back in June of 2025.
It did, which is a big deal. It streamlines the whole review process and allows for a rolling BLA submission, which they're planning for the second half of 2026.
What's the tech that stands out here?
It's their conjugated delivery platform. This formulation allows for topical application.
On the skin.
on the skin with 94% tissue retention.
Wow, that's a huge advantage over systemic or whole body delivery that some competitors require.
A massive advantage. If this works, it could carve out a substantial niche in a multi-billion-dollar dermatology market.
So there are some near-term data readouts coming up that investors should be watching.
Yes, a few key catalysts. We've got Q2 2025 earnings coming up in August.
But tactically, investors are focused on the other data.
Right. The RVX 212 skin penetration data is being presented in late August.
And then there's the NASH data.
Yes, the Phase 1 NASH data for RVX 208 is being presented at a major conference in September of 2025. These are classic catalysts that can really move the stock.
So how is the market taking all this in? The perception seems to have improved a lot.
Dramatically. It's been fueled by all this clinical progress. The analyst consensus is very supportive, highlighting the narrowing losses in that clear NDA path.
What are the price targets saying?
Well, several analysts have buy ratings with targets all over the map, really, from $2 up to $7.
But the average is what?
The average 12-month price target is $3.86.
So given where the stock is trading now, that implies several multiples of upside if the catalysts actually materialize.
A lot of upside. And we're seeing institutional conviction rising, too.
High institutional ownership. And some big funds have been initiating positions.
Yeah, names like D.E. Shaw and Crescendo Capital. And on top of that, you have the insiders themselves.
They've been buying them.
They bought over 86,000 shares in direct purchases between February and May of 2025. That's a really strong sign of internal confidence.
Okay, but we have to discuss the risks here.
We absolutely must. The primary risk is, and remains, the binary nature of the FDA path.
The entire thesis really depends on a successful outcome from that Q4 2025 pre-NDA meeting.
And then subsequent approval. If the FDA raises any new safety or efficacy concerns, the whole story changes.
The whole thing. And the other risk is financing and listing compliance.
Right. While the recent capital raises extended the runway, they're still not compliant with the Nasdaq $1 minimum bid price rule.
And that deadline is November 2025.
It is. This could force them into a reverse stock split.
Quits is mechanically neutral, but optically it's pretty negative for investors.
It can be. However, it's worth noting that the company has already addressed its market value compliance issue, which shows management knows how to navigate these requirements.
So what does this all mean when you put it together?
We have a high-beta, catalyst-rich biotech with multiple shots on goal.
You have the late-stage CNS asset heading for that huge Q4 FDA meeting.
And you have a fast-track dermatology asset with data coming out this quarter.
The risks of dilution and a regulatory setback are very real, but you could argue they're already priced into the current valuation.
Which sets up a powerful asymmetric opportunity. For investors comfortable with that kind of binary risk in biotech, the focus should be on tracking that Q4 FDA meeting outcome.
A positive outcome could trigger a significant re-rating, bridging the gap between where the stock is now and those ambitious analyst targets.
A lot to watch over the next 3 to 12 months.
Indeed. If you enjoyed this analysis, make sure you hit that subscribe button to keep getting the latest insights on catalyst-driven stocks right here on Smart Wealth with Joshua.